Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. Russian war has finally started to cast a shadow over India's balance of payment. Rising global commodity prices, especially that of crude oil, have widened India's current account deficit to 2.8% of GDP in the first quarter, highest in nearly 4 years. But RBI Governor Shaktikanta Das appears confident. On Friday, he said that foreign exchange reserves compared favorably with most peer economies. Das also said that India's external debt to GDP ratio was the lowest among major emerging market economies. Our next report does a reality check.
India's April-June current account deficit, or CAD, came in at $23.9 billion, or 2.8% of GDP. This was much higher than the $13.4 billion, or 1.5% of GDP reading in January-March 2022. In FY22, the CAD was 1.2% of GDP, or $38.7 billion. But this may come as a relief as analysts and agency reports expected the CAD to hit a 9-year high of 3.4 to 3.7% of GDP. Nonetheless, the Q1 FY23 CAD reading represented a 15-quarter high, driven by an elevated merchandise trade deficit. The expectation in various quarters is that the deficit may remain elevated in the second quarter too, amid the slowdown in exports growth and the depreciating rupee. There were also apprehensions that the CAD could widen all the way to 5.5% of GDP in the second quarter, which would be the second worst quarterly deficit on record after the 6.8% reading in the third quarter of 2012-13. One agency had estimated that for the entire year, CAD could widen to a decade high of 3.8% of GDP in 2022-23. According to a Kotak Economic Research report from Friday, the external sector risks remained high. The report said that overall, the balance of payment, or BOP, in Q1 FY23 was marginally positive, with the lower than expected CAD being one reason. However, it said that as global slowdown risks were increasing, the agency was raising its FY23 CAD estimate to 3.9% of GDP from 3.4% earlier. This is a cause for concern, since the RBI believes that India can sustain a CAD in the 2.5 to 3% range without getting into an external sector crisis. So, how are things likely to pan out for the full year?
So we're looking at a number of something like 3 to 3.5% for the entire year.
According to the Reserve Bank of India, the country's forex reserves continued their southward journey, declining by $5.219 billion to $545.652 billion for the week ended the 16th of September. The central bank's bid to stall the rupee's decline against the greenback has been responsible for this fall in reserves. However, experts reportedly said that the decline in foreign exchange reserves was not a worrying factor. They said that there was coverage for 9 months of imports. At a peak of $642 billion in October last year, the reserves had been sufficient to cover 16 months of imports. Still, worries persist. A recent Reuters poll found that India's foreign exchange reserves were likely to drop another $23 billion to $523 billion, falling to their lowest level in more than 2 years by end 2022. This would mean a further shrinkage in the import cover too. The rupee has depreciated about 8.4% against the dollar so far this year. According to the Kotak Economic Research report, the rupee is expected to remain under pressure as markets continue to assess the extent of spillovers on the emerging markets currency space from the US Fed's aggressive tightening, the European crisis, and geopolitical risks. However, for its part, the report expects the RBI to become more prudent in the second half of FY23 while intervening in the currency market. According to the RBI, underlying the Q1 FY23 CAD was the widening of the merchandise trade deficit to $68.6 billion from $54.5 billion in Q4 FY22 and an increase in net outgo of investment income payments. There has been an upward pressure on India's import bill because of the Russian invasion of Ukraine. There are some bright spots too. Some of the pressure from external sector headwinds has been easing of late. This has come with the RBI's monetary policy being in sync with the global policy stance. Commodity prices have also fallen from their recent peaks, and there is stability in capital inflows. Delivering the MPC report on Friday, the RBI governor said that services exports and remittances could narrow the trade deficit. The governor said that services exports did very well in July and August this year, and they grew at a robust pace of 35.4% year-on-year during April-June. For the same period, remittances also rose by 22.6%. Das also said that while the Indian basket crude oil price was around $104 per barrel in the first half of FY23, the RBI was now assuming it to be $100 per barrel in the second half.
The current account is going to continue to be under pressure primarily on account of the trade deficit. Given the fact that India is one of the faster growing economies in the world at 7%, going by what the RBI has projected, it would mean that the demand for imports would go up. Now, our exports, on the other hand, would probably be in a negative zone in terms of growth or marginal growth, if at all we cross the positive, get into a positive territory. Reason being that our exports are more dependent on the global economy. And if there is going to be a recession in the West, that would actually get reflected in terms of slower growth in India's exports. The crux actually would be as to what happens on the capital account. Now, here I think the picture is not very clear because we have seen certain months where the FPIs have been positive, certain months where they've been negative. And I think the FPI would hold a clue as to whether we would be able to balance a balance of payments, that is our external account, in a more positive manner. What the RBI governor has mentioned, where he said that 2/3 of our reserves value, which has come down, is due to valuation reasons. So that could be the driving factor in bringing the reserves down. But on the whole, there would definitely be a subtraction in our foreign exchange reserves. The vulnerability of our external account will definitely increase, primarily on account of the fact that the CAD is going to widen. And the FPIs will be quite uncertain because they have been volatile in the last couple of months.
As the Kotak Economic Research Report said, capital flows will remain the key risk to BOP deficit. The RBI will need to keep its policy in tandem with its global peers to avoid a capital flight.
Indian automobile industry seems to have shrugged off the pandemic blues with fancy models, especially SUVs. Notwithstanding the global uncertainty and lingering chip shortage, it has posted a healthy growth in the last few months. But wait, if you're planning to book your favorite model during the ongoing festival season, then think again. Our next report tells more.
By the end of September, summer starts giving way to the fall. The pleasant weather also ushers in harvesting and festival season in the entire country, which starts with Onam and Navratri and goes on till Diwali. People go on shopping spree, flooding markets and shopping malls. Online purchases also hit the peak during this period. Mobile phones, TVs, refrigerators, washing machines sell like hot cakes due to the irresistible offers. But what about cars? Hit hard by the pandemic, passenger vehicle makers were waiting for the festival season for more than one reason. First, they expect to see record volumes. Second, they expect a swift recovery in their profitability to pre-COVID levels. Chrysler Research says that cumulative retail sales in October and November are expected to touch a record 650,000 to 700,000 units, and dispatches to dealers are expected to cross 1 million units in the September quarter. But there is a spoiler. The good news may not extend to you, the buyer. Across brands, the average waiting period for popular models is about 3 to 4 months. This suggests that there may be more buyers chasing new cars than the car makers can supply. Shortage of chips and pent-up demand in the wake of the COVID-19 pandemic are the reasons. So, buyers should expect limited discounts on offers, and offers will mostly be limited to vehicles seeing low demand such as some entry-level hatchback models. In the beginning of September, the industry was estimated to have about 700,000 pending bookings, with Maruti Suzuki alone accounting for 377,000 units. So what will be the trend this festival season? There will be strong demand for top-end trims on the one hand and negligible discounts on select models on the other. The sales trend till August indicates that while the growth momentum has continued for SUVs, it has hit a plateau for sedans. So those looking for discounts may want to try their luck with the latter. So how much can we expect to save even where discounts are on offer? An analysis of available reports on recent offers shows that you may back discounts ranging from 20,000 to 45,000 rupees, that too depending on the model and trim. Finance schemes and exchange bonus benefits will also be there. But that is a far cry from the past festival season SOPs. Discounts on passenger vehicles had reportedly gone up to 1 lakh rupees for some models in 2019. Even where discounts are on offer, they are small for the most part. Mahindra & Mahindra, which only recently started deliveries of the Scorpio N, has bookings for 100,000 units, and depending on the variant, the waiting period is 70 to 90 weeks. There is not much incentive then to offer good discounts. In the beginning of September, Autocar India reported that Honda was offering discounts and benefits on its 4th and 5th generation City, Amaze, Jazz and WRV models. The 5th generation Honda City, a mid-size sedan, got the most discounts. On offer were either a cash discount of 5,000 rupees or free accessories worth 5,496 rupees. A discount of 5,000 rupees and a bonus of 7,000 rupees was also on offer on car exchange. However, no discounts were on offer on the City Hybrid. Right before the start of the festival season, Maruti Suzuki offered discounts on the Ciaz, XL6 and Ignis. It is offering benefits of up to 48,000 rupees for all variants of the Ciaz sedan. The Ciaz saw a 29% year-on-year drop in sales in August 2022. It was also Maruti's worst selling model that month, accounting for just 1.13% of total units sold across models. For Ignis, a small hatchback, the automaker is giving a consumer offer of up to 10,000 rupees and an exchange offer of up to 15,000 rupees. Maruti Suzuki has also been offering heavy discounts on Celerio, Espresso and Dzire in September. Tata Motors has also come out with offers for Navaratri, Dasara and Diwali, but it is offering discounts on 5 models, which are the Tata Harrier, Safari, Tiago, Tigor and Nexon. Including cash benefits, exchange bonuses and corporate discounts, buyers can expect a discount of up to 40,000 rupees on these cars. The discounts on Tata Motors' most selling SUV, the Nexon, may interest you the most. A total of 20,000 rupees in discount is on offer for the SUV. The company is also offering a 15,000 rupee exchange bonus on its diesel variant, along with a corporate discount of 5,000 rupees. These offers come at a time when Tata Motors is shifting its focus to electric vehicles, targeting a 5-fold rise in their sales by FY24.
Typically during festival season, generally car manufacturers, they stock the dealers, and primarily the inventory level goes up. But this time, the festival season is quite different because inventory at the dealership is close to 20-25 days against 45 to 60 days, which is a general trend before festival season. So since the inventories are very less at the dealerships, so obviously no discounts, and moreover, most of the models, typically new models, which contribute to almost 60-65% of the sales. So there is a good waiting period of, if I talk about every waiting period, that is roughly around 3 months. Otherwise, there are models where the waiting is up to 12 months. So obviously, long waiting period for the models coupled up with very low dealer inventory, results in no discounts. And moreover, I think today even the customer aspiration is more like, if he gets the vehicle, I think there is smile on his face.
On their part, car makers cannot breathe easy just yet. Experts see the boom led by pent-up demand ending in some months. Going forward, their performance will also depend on how production pans out against the underlying demand. With discounts off the table, buyers will have to be content with the fact that automakers are diligently trying to at least bring down the long waiting periods on the cars they seek to buy.
Moving on to markets, benchmarks ended nearly flat after a challenging first half of FY23. The Nifty 50 and the BSE Sensex dipped around 2% during the first 6 months of the financial year. But the indices may be eyeing greater volatility in the remaining part of this fiscal. Our next report outlines how the next 6 months of FY23 may shape up for equity markets amid tighter monetary policies.
Global turbulence since the outbreak of the Russia-Ukraine war led to a V-shaped market trajectory in the first half of the current fiscal. In 3 months to June, investors went looking for cover as equities crashed in the backdrop decadal high global inflation and disrupted supply chains. However, from July to September, Indian equities bounced back on the back of steady economic growth despite interest rates hikes by the Reserve Bank of India and the return of foreign portfolio investors.
First half of the financial year was actually a very challenging time for the financial markets, mainly on account of the lingering impact of the Russian invasion of Ukraine and the global inflation, the hard money policy followed by most of the central banks, including the Fed and ECB and the Reserve Bank of India. All these things posed a major challenge to financial markets.
The benchmark S&P BSE Sensex and the Nifty 50 indices fell about 2% each between April and September this fiscal year. In the broader markets, the small caps suffered sharper blows, with the Nifty Small Cap Index plunging around 9.5%. On the contrary, mid-caps were the only rewarding segment, with the Nifty Mid-Cap Index climbing 3% during the period. Among individual stocks, Adani Power and Mazagon Dock Shipbuilders more than doubled investors' wealth in 6 months as they surged over 100%. On the downside, Brightcom Group, Tanla Platforms and TV18 Broadcast cracked up to 65%. Going forward, analysts expect India Inc.'s corporate profitability to take beating in the second half of the fiscal year amid sustained monetary tightening.
Tight money policy being followed by the central banks, the dwindling liquidity in the markets and the rising interest rates will all have some impact on the financial markets and would also impact the cost of funds and also to a large extent the corporate earnings and corporate profitability. One of the things which investors could be looking at is that every time there is a corrective downward movement in the markets, please buy into the markets to build a long-term investment portfolio.
That said, the near-term texture of the markets remains uncertain, with global headwinds weighing on the sentiment. In this holiday-truncated week, a slew of macroeconomic data will guide equities, including September GST collection data, manufacturing and services PMI data, and auto sales data. That apart, investors may see fund rotation ahead of the Q2 results season.
Not just the stock movements, but you can also watch Supreme Court proceedings live now. Last week, the Apex Court started live streaming proceedings of constitution benches. But what exactly is a constitution bench? Our next report explains.
The Supreme Court referred a case related to framing the uniform rules around capital punishment to a constitution bench. The Apex Court said that it is necessary due to differences in various judgments on the issue of the validity of the death penalty. But what is a constitution bench? Article 145(3) of the Constitution makes it clear. It says, any case involving a substantial question of law as to the interpretation of the Constitution must be decided by a bench of at least 5 judges. Such a bench is called a constitution bench. It will have 5 or more judges of the Supreme Court. In India, these benches are temporary and are dissolved once a legal question or issue is settled. The Chief Justice of India has the power to set up a constitution bench, and he is the one who refers cases to it. Currently, there are 4 situations when such a bench can be formed. First, if a case involves a substantial question of law related to the interpretation of the Constitution. Second, a bench can be formed if the President seeks SC's opinion on law or fact. In this case, however, the apex court's decision is not binding on the President and they can take a different point of view. Third, a constitution bench can be formed when a 2-judge bench and later a 3-judge bench deliver conflicting judgments on the same issue. Lastly, it can be formed if a 3-judge bench delivers a judgment that is different from the judgment delivered by a previous 3-judge bench on an issue. Largely, the Constitution bench gives an overarching view on a question of law and defines a path the law will take in the future. In India, D.Y. Chandrachud has been a part of 21 constitution benches, the highest in the country. He is followed by Justice A.M. Khanwilkar and Ashok Bhushan with 15 and 10 benches respectively.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In 2018, senior advocate Indra Jaisingh had approached the Apex Court asking it to consider live streaming some important cases. That's all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.